going to try and hit the highlights for here tonight as it pertains to small businesses, right? So we have the Tax Cuts and Jobs Act, and how does that impact all of us as small businesses is really the question. What I've done for all of us here is I'm going to hand these out is just a real good snapshot on individual tax rates, where they were and where they're going. And we'll take a look at this as we proceed here. But you'll see generally that the current tax brackets have been reduced. So when we look at the name of the act itself, Tax Cuts and Jobs Act, the purpose of the new tax law was to create jobs. At least that's one of its missions, is to create jobs. From everything we've heard in the last year, it seems that it's been successful. But there are two components in terms of businesses. They're called big business and small business. If you're a big business, if you're a C corporation, you just got the greatest deal you could possibly get. Your corporate tax rate went from 35% down to 21%. It's massive. Now, what does that do? On the larger level, the big companies, the car manufacturers, Amazon, any of these companies that are big, they can buy more property, not only real property, but equipment. They can hire a lot more employees, and it all comes back into the country. And that's the nature and extent of what they're trying to do on a big-time corporate level, is bring manufacturing back to the U.S., bring big business back to the U.S. And it's important as we discuss these, because one of the things we're going to talk about is qualified business income. And one of the things that's not included in that definition, what can you use as business income? You can't use, in most instances, profits you've derived from work overseas. So if you're manufacturing overseas and bringing it back here, that's going to work against you to some degree. That's the big business. I'm really here to talk about the small business, which, for lack of a better yardstick, would be a company that has an average income of $25 million average over 3 years. So if you're a $25 million company during the 3 years or less, you're a small business. I can venture to guess most of us here probably fit into that category. There's also a distinction, and we're going to get into this in a minute, because one of the big things about the new law as it pertains to small business is this deduction, this 20% deduction, all right, for pass-through companies. All right, so if you're a single proprietorship, if you're a partnership, if you're a limited liability company, you get certain benefits that result in a 20% tax deduction off of your adjusted gross income. So if you, as a business, brought in $100,000, your adjusted gross income shows as $100,000, you get a 20% discount on that. It brings your taxable income down to $80,000. That's awesome. It's a big plus for most of us. That's the good news. The not so good news is, as I'm hearing from the crowd, a lot of us are in the service business, all right? Accountants are here, planners are here, attorneys are here. We have a different set of rules. We don't get as much benefit as other types of small businesses. All right, so what I want to first do is talk to you a little bit about this pass-through, all right? You get the 20% deduction if, let me take another step back, I'm sorry. What is a pass-through, all right? Pass-through company is a company like the company I'm in, a partnership of lawyers. I have 4 partners. All the money that comes into our firm is essentially, what's left over is profit among the partners, okay? Our company doesn't get taxed, we get taxed. The income from our company passes through to us, and then we file our tax return, all right? So, in using my company's example, with the attorneys in our firm, the partners in our firm, we have a formula. And so at the end of the year, we all know what we derive from that, the income we derive from that. But more importantly, at the beginning of the year, we set a forecast for where we think it's going to land. And we're usually pretty accurate with that. So come the end of the year, there could be partners in my firm that have made more money than me. There could be some that have made less money. But it's all gonna balance out on the balance sheet. All the profit is gonna be divided up among the partners. We'll have to declare that as our income for the year on income tax returns. The difference is this: the limit on that number is $315,000 worth of income if you file jointly, right? So if you own a company, you're married, your spouse doesn't work or makes limited income, or between the two of you, you bring in $315,000, then you get the 20% deduction. If it's a single filing, it's $157,000 of income, you get the 20% discount. If you're in the service business, if you're the accountant, if you're the lawyer, if you're the financial planner, after that $315,000, there is no deduction. It's wiped out. You're not allowed to use it. So if I make $316,000, I'm done. I can't get that deduction. It's different if you're not in that class, if you're not the lawyer or the accountant, the service person. It staggers then for another $100,000. There's a formula where they factor in your W-2 payments and real property purchased in the context of the business. So if you have a company, 50 employees, and a $10 million property, and when you look at that, you have to exclude the real property and only focus on the building. If you have a lot of payment, it's going to help to get that number down, all right? So with the 315, again with the attorneys and so forth, after that, so and again using the sheet I just gave you, so if you look to it, so on $315,000 filing jointly, we know that that's going to be a 32% tax. Where, I'm sorry, 28% tax, where 33%, I'm reading this backwards here. It is 32, I was right the first time. It was right the first time. 32, but it's only down 1%, right? It's down 1%. If you're not in the class of the tax advisor, accountant, and so forth, when you go above the 315, again, I'm talking in terms of the joint filing right now. If you go above the 315, up to $415,000, there's a formula. So you're still going to end up with a deduction. It can never be more than 20%, but it could well be close. So if you make the $315,000 or less, you're definitely going to get the 20% deduction. If you make over it up to $415,000, you're going to be in the ballpark. When you get up and over $415,000, then you lose a deduction as well. All right? But this is a bonus. It's an effort really to generate more, retaining more income in the company if possible. That expires in 2025. So here it is. It's really, and a lot of that happens in the tax code where things are there for a short period of time or a limited period of time and then they disappear. So that's one of them. You can hear this term qualified business interest. Essentially what that means is it's profit. You take your regular business deductions from your total income. What is not QBI, qualified business interest? Capital gains is not, dividend income is not, interest income is not, and there's a whole list. What I will do later is I have a nice nifty handout from the IRS, which gives you a nice breakdown of a lot of the things that I'm talking about here today. One of the other important items here is there are standard deductions which have increased, and itemized deductions which have either been limited or taken off the table completely. So for instance, we now have a problem with the state and local tax, otherwise known as SALT deduction, all right? For many of us in this room, that was a big plus, right? We all live in New Jersey, we all have high taxes, and at least at the end of the year, you can say, oh, at least I get something back, I get a benefit back from that. Well, that's now reduced to $10,000. You cannot declare more than a $10,000 deduction for your state and local taxes. So your real property bill, where you thought you were at least had some saving grace at the end of the year, now you can only use a part of that as a deduction. That will be here. Getting back to the other types of professionals that are excluded on the 20%, people in the healthcare industry, the legal industry, accounting, actuary, performing arts, the consultants, athletics, financial services, brokerage services, investing in investment management, trading securities, and then there's this broad category called those companies that rely on reputation and skill, and it's very unclear, very undefined, and it's causing a lot of people headaches even to this moment. It's very, very confusing. One of the other big drawbacks in the law in terms of everyone in this room is what do we do a lot? We do a lot of entertaining, all right? We take people to a game, to the theater. It's off, it's gone. You cannot use that anymore as a deduction. It's not a legitimate expense. You can use meals, you can wine and dine people and get a 50% deduction back on that, half of what you spent on the meal.
That's good.
But you have to talk business. It's got to be business related. You've got to be able to back that up to some degree. So, and again, that's what I'm saying, these itemized deductions, some of the deductions that we have taken for granted over the years have disappeared. And it's not entirely clear why that happened, but it does make it much easier to set a formula for everybody that works. Here I am going we're into the tax season. I don't even know what my personal taxes are going to be until I get to the accountant and do it all. You've paid your quarterly taxes. I'm sure many of you have paid quarterly taxes. That's one thing that I would say, always keep an eye on. We'll get a good taste of where we land by April 15th when before we file our returns. So going forward next year, make sure you do yourself a service, and if you are paying quarterly taxes, park as much money as you can in there to at least get close as you can, if not a little bit over. Play it safe because you don't want to get hit with the penalties and with the interest that can occur from the late quarterly interest filing. All right, so on the standard deduction, it went from $12,700 up to $24,000. All right, so now when you look at your SALT tax that you would get some credit back for, maybe you had itemized deductions. If you were lucky with everything, $30,000, $40,000, depending on the type of house you own and some of your other expenses. Now, it may well be that the standard deduction, which most of us might not have used over the several years, you might not want to use that, and you're not going to know that till you crunch numbers and see where you land. So you have the $24,000, and again, I'm talking in terms of filing jointly. On an individual basis, that standard deduction has gone from $6,350 up to $12,000. You can get a mortgage interest deduction. For those who had property purchased before 2018, the limit is $1 million, but it's got to be on acquisition, not on refinance. For newly acquired property, since the law took effect, it's $750,000 is the limit. So you can expense that as an interest deduction up to $750,000 on mortgage. This is another change in the law. If you have a net operating loss, you were able to use that and go backwards with it. But now you can only go forwards with that net operating loss. You can use that net operating loss until it's gone. So you can use it forever until it disappears. This is another important one. You get a fully deductible business interest expense, and you get a bonus depreciation. That's really what I want to focus on. We've all bought equipment, computers, vehicles that we use in our business, and then they get amortized over different periods of time. Some things can be amortized for as many as 19, 20 years. The law has changed so that you can depreciate it all in your first year if you want to. All right. So if you've had a very good year and you need to do something to bring your taxes down, go out and buy yourself a car. Yep. Go out and buy yourself computers. Put money back into your business so that, and then you can expense it and you can write it right off in that first year if you want to, as opposed to using it over time. And again, that's 100%. You get to use 100% of that. So now, just really hitting a couple other quick points here. So we talked about entertainment. We talked about interest. Here's another one. Again, this applies not necessarily to small business, but across the board. 1031 exchanges are what are known as like-kind exchanges. You could buy a business asset. You could sell it for a profit, but then you could take that money and buy something else so that you don't recognize a gain on it. The rules have been changed now that the 1031 exchange will only apply to real property and nothing else. So that's an important change to be factored. There was a time where you could get your alimony written off. That's no longer the case. And a lot of other things. So maybe I'll do that right now, is hand this out. And this is an IRS publication, and I thought this was very helpful in just kind of giving you a broad view of the various items that come up. You're welcome. And this document compares where we stood between the 2017 law and the new law, and it discusses deductions, discusses depreciation. Changes to fringe benefits, which is, we touched on it here, but you've just got to be very, if you look at this list, it'll give you a real good example of some of the things that you can get credit for and some of the things that are just not going to happen. Same thing with tax credits. And I talked about structured topic, which I really did not delve into. But in a nutshell, just come back to where we started. The intent and purpose of the law is to essentially give us a little bit more help, maybe, if you're not a professional, all right? Because in most instances there, I think we got shelved here a little bit. And oddly enough, it was that's the other criticism with the law is, a lot of this was written like the night before. So last minute, while attorneys and accountants don't get the benefit of the 20% deduction over 315, architects and engineers do. Now, I work with architects and engineers every day as a land use lawyer. It makes no sense to me why that's the case. We both appear in front of planning boards and consult with people. So that's the big one, and then really limiting the types of deductions and the amount of those deductions. It's really unclear where we'll land. I venture to guess that as long as we're in that $315,000 range, as a joint filer, we're gonna do better, than we were last year. Once you start going north of that, this new law really is not gonna be all that helpful. So that's what I've got to offer for you here today. I'll try to answer some questions if you have them. But anyway, that's it.
Does anyone have any general questions?
This form says 2017, so it'll apply in 2019?
Yes. Yes, absolutely.
So the changes really started in 17?
No, 17 was the old law.
Yeah,
It's
Oh,
not.
the law.
That's the old law, I'm sorry. So the the TCJA is the new law. All right, to the
Oh,
right.
okay, all right.
So your tax filing is here.
Yeah, yes,
So
for this year.
2019.
Yeah,
I
yeah.
see that's a good change. Whereas for me, like in the service, I do service, right? I can write off 100%.
And you have vehicles. And you have vehicles.
And I have vehicles.
Yes.
So it's,
Again, yeah.
now my question is, the thing I like is that you can write off until it's entirely, like first year you can take 10%, 10,000 and so forth until the whole thing is
Yes.
it's 100%.
Yes. Yeah, right. So, again, so, you know, if you've had an okay year and you don't need to write off as much, that's great. If you've had a great year and you need to write off more, that's great too. But just know that you don't have the benefit to use that going forward.
After the 100%.
Right.
So technically you got 3 years.
No, you've got much more than that.
Oh, that's
You
good.
spread it out, right.
I can write off everything except for entertainment, like taking you to the ballpark.
And 50% on the meals and the
What
wine.
about uniform?
Is that a typical business expense? Yep, then that comes right off your bottom line.
Yeah, but if you give it to a 501c3,
No, not a 50, that's a church, yeah?
no, because I have a 501c3 as well. What actually ends up happening is as long as, like, you can give a check and that's totally tax deductible.
Oh, but that's nonprofit, right?
Right, you're
I'm not
giving, you're
nonprofit.
giving to a nonprofit.
Make some money?
So the way that
That's not
works,
a change.
so the way that works is, let's say you
That's
go to a
some
golf
money.
outing. All right, you go to the golf outing and you paid X dollars, you get a couple $100 to participate. And the 501c3s all do this now, is they'll give you back a letter that tells you what the value of the meal was. So maybe it was a $50 value, and everything else becomes a donation. So you gotta distinguish between the value paid for the product versus the charitable donation.
So donations you can write off.
Yes.
Yeah,
And the other, see, the 503E, it's a certain value in that. You know, only a certain amount. Like, say I donate to charity, maybe 100, but they're not gonna allow me the 100%, say it's $100,000, they're not gonna allow me the 100%, only a small percentage that I can write off
I
on.
don't know what the percentage
no,
is.
it's larger
You
than,
can write off most of it though.
yeah.
Depending on what the donation is paid for.
So like I do special events here just in case everybody didn't catch that. And when you donate to us, we give you the
form,
tax,
the
the tax deduction. You get a what's it? Oh God, it's another like a 1040. Not a 1040. What's the W9? You get a W9. And then we'll send you any other additional forms you need. Usually your check can also serve as proof that you gave the donation. And then also we can send a letter on receipt. The IRS does accept the check.
Check or a letter.
Yeah.
Okay, that's good.
Any other questions?
Talking about the income level, the adjusted gross income.
Yep.
So that adjusted gross income includes the income from the business entity, the LLC. Okay, plus any W-2s that we might get from other employment.
Yes. So again, that's essentially if you think of it in these terms, yeah, you're in your business and you're not getting a paycheck, you're getting a draw, or you're not getting paid at all. So it's looked at differently, but you're still filing one return, and so whatever income you derive, and again, if you're filing single or if you're married or filing jointly, yeah, if you have two people working in the home, it's one tax return and it's going to have everything on it.
This is tax structure comparison for businesses. Does this cover all business entities, proprietorships, LLCs, corporations, cover all businesses?
Again, the past,
Little-
there's the C corps are on their own land. Yeah, pretty much everything else is what we're.
So this is the pass-through style?
Pass-through, yes, yes. So all those entities you just mentioned, and you know, by the way, you know, we're a fairly sophisticated firm. We've got a lot of well-to-do clients, but I can tell you right now, they're all small companies. You know, most of them are limited liability companies as a rule. They're just easier to form, and they're easier to change as time goes by. And you know, our world is the $25 million and under client, which is still a really good client to have. But we're seeing, you know, the LLCs as the predominant method in which they form.
The S corp LLCs.
Yeah.
Does your firm prepare taxes or just represent taxpayers?
Represent. We don't do any of the actual filings. We do more on the estate level.
Okay.
Does your firm,
Yeah. There you go. This guy can.
he already went. I'm only kidding. But do your firm form, LLCs, corporations?
Yes.
Okay.
Yeah.
How long does it take?
It's quick.
I need your card. We need it now.
Yeah,
Yeah,
so,
and black.
right, so the other thing here is, you know, this all does apply to sole proprietorships, and it's just very dangerous to have a sole proprietorship. You know, everything's on the line, you've got no real protections there. So yeah, if you want to get out being a sole proprietor LLC, it's a wise choice.
Very good. Thank you all so much for coming. I know that you're going to be out a little while.